In October 1929, the world stood on the edge of an abyss it couldn't see coming. The markets had never been stronger, credit had never been cheaper, and confidence had never been higher. Then, in a matter of days, $30 billion vanished, the equivalent of $500 billion today. Fortunes evaporated, banks collapsed, and the global economy entered a decade of darkness. But here's what they don't tell you. The crash didn't start in October. It started years earlier with decisions made in silence, systems built on borrowed time, and a financial architecture designed to break. And if you look closely at 2025, the exact same architecture is being assembled again. The question is, do you see it? Welcome to the Wealth Timeline, where we uncover how money, power, and history are woven together to shape the world we live in. Today, we're tracing the invisible threads connecting 1929 to 2025, and revealing the structural pattern that governments, central banks, and financial institutions hope you never notice. To understand what's happening now, you need to go back to the 1920s, an era that looked, on the surface, like a golden age. The First World War had ended. America was booming. The stock market was soaring. New technologies, radio, automobiles, electricity, were transforming daily life. Credit was flowing freely, and Wall Street became the symbol of a new kind of prosperity, one built not on gold or land, but on leverage, speculation, and belief. It was called the Roaring Twenties. But beneath the roar was a hum, a quiet, mechanical sound that few people understood. It was the sound of debt compounding, of credit expanding faster than production, of a financial system that had decoupled from reality. And when reality finally caught up, it didn't whisper, it screamed. But what if the scream wasn't an accident? What if it was the system working exactly as intended? The seeds of 1929 were planted in 1913 with the creation of the Federal Reserve. For the first time in American history, a central banking system was established to control the money supply, set interest rates, and act as a lender of last resort. The stated goal was stability. The actual result was something far more dangerous: the ability to manufacture credit out of thin air. By the early 1920s, the Federal Reserve began lowering interest rates to stimulate growth. Borrowing became cheap. Investors poured money into stocks, not with their own savings but with borrowed funds. This was the birth of margin trading. You could buy $100 worth of stock with just $10 down, borrowing the rest from your broker. It was intoxicating. The market rose 400% between 1923 and 1929. Fortunes were made overnight. Shoeshine boys gave stock tips. Housewives speculated on railroad shares. Everyone believed the boom would last forever. But here's the secret. The system was never designed to last forever. It was designed to expand until it couldn't. And when expansion stops, contraction is violent. By 1928, credit had grown so fast that the ratio of debt to GDP reached unsustainable levels. Banks were lending to people who couldn't repay. Corporations were borrowing to buy back their own stock. And the Federal Reserve, instead of tightening policy, kept rates low, because raising them would have triggered the collapse a year early. So they waited, and the bubble grew larger, until it didn't. The mechanism. Let's talk about what made the 1920s economy so fragile, because this is where the parallels to 2025 become impossible to ignore. First, asset inflation driven by cheap credit. When money is easy to borrow, people don't invest based on value. They invest based on momentum. Stocks rise because they're rising. Real estate appreciates because it's appreciating. The fundamentals stop mattering. Second, wealth concentration at the top. By 1929, the richest 1% of Americans owned 40% of the nation's wealth. The bottom 93% held just 20%. This meant that consumption, the engine of economic growth, was entirely dependent on continued borrowing. The moment credit tightened, demand collapsed. Third, a banking system built on leverage. Banks weren't just lending money, they were creating it. For every dollar deposited, they could lend out 9. This worked beautifully in a rising market, but it meant that any disruption would cascade instantly. And finally, the illusion of safety. In 1929, most Americans believed the market was backed by something real. They didn't understand that stock prices were abstract representations of future earnings, inflated by speculation and sustained by belief alone. When belief cracked, everything cracked with it. But here's the question historians rarely ask. Who benefited from the crash? Because while millions lost everything, a small group of insiders, those who understood the cycle, who had access to liquidity, who knew when to exit, didn't just survive. They thrived. The collapse? On October 24, 1929, Black Thursday, panic began. Investors who had bought on margin received calls from their brokers. Deposit more money, or your shares will be sold. But there was no more money. People scrambled to sell. Prices plummeted. And the selling triggered more margin calls, which triggered more selling. It was a death spiral. By October 29th, Black Tuesday, 16 million shares were traded in a single day. Ticker tapes couldn't keep up. Fortunes disappeared faster than they could be calculated. Men who had been millionaires at breakfast were bankrupt by lunch. And the Federal Reserve? They did nothing. They watched. They waited. And when the smoke cleared, they began buying assets at a fraction of their former value. Here's what most people don't realize. The crash wasn't caused by a sudden loss of wealth. It was caused by a sudden loss of liquidity. The wealth was always fictional, a number on a ledger, sustained by confidence. When confidence broke, the system revealed its true nature. It was a mechanism for transferring wealth from the many to the few. Within 3 years, 9,000 banks had failed. Unemployment reached 25%. Global trade collapsed by 65%. And the world entered the Great Depression, a decade-long contraction that only ended with the outbreak of World War II. But even as the economy burned, something else was happening quietly in the background. The government expanded. Central banks gained unprecedented power, and the financial system was restructured. Not to prevent future crashes, but to ensure that the next time it happened, the people in control would be ready. The legacy. The 1930s reshaped the global order. In America, the New Deal created massive government programs, not to help the poor, but to stabilize a collapsing system. Social Security, unemployment insurance, bank deposit insurance. These weren't acts of charity. They were mechanisms to restore confidence in a broken structure. In Germany, hyperinflation and economic despair gave rise to fascism. In the Soviet Union, the collapse of capitalist economies was held up as proof that communism was the future. And in Britain, the empire began its slow, inevitable decline. But here's the part that matters. The crash didn't destroy the financial system. It refined it. By 1933, the Glass-Steagall Act separated commercial banking from investment banking, a firewall designed to prevent speculation from contaminating the money supply. Gold was confiscated from private citizens and centralized under government control. And the Federal Reserve gained new powers to intervene in markets, manipulate interest rates, and control the flow of money. The lesson wasn't, don't build bubbles. The lesson was, build better mechanisms to profit from them. And for the next 70 years, that's exactly what happened. Until 1999, when Glass-Steagall was repealed, and the firewalls came down. Now let's talk about today. Since 2008, central banks around the world have injected more than $25 trillion into the financial system through quantitative easing, the modern equivalent of printing money. Interest rates have been held near zero for over a decade, and asset prices, stocks, real estate, bonds, have reached levels that defy historical precedent. The S&P 500 has risen over 500% since 2009. Real estate prices in major cities have doubled, tripled, even quadrupled. And corporate debt has exploded to $10 trillion in the US alone, much of it used not for productive investment, but for stock buybacks and dividends. Here's the structure: cheap credit, asset inflation, wealth concentration, and a banking system built on leverage. The exact same architecture as 1929, but this time it's global, and it's bigger. In 2025, the richest 1% own nearly 50% of global wealth. The bottom 50% own less than 2%. Consumer debt is at record highs, and the only thing keeping the system afloat is the belief that central banks will never let it fail. But belief is fragile. In 2023, Silicon Valley Bank collapsed in 48 hours, the second largest bank failure in U.S. history. In 2024, commercial real estate defaults began accelerating as remote work hollowed out office buildings. And in early 2025, corporate earnings started missing forecasts as consumer spending slowed under the weight of rising interest rates. These aren't isolated events. They're tremors. And just like in 1929, the people in power aren't sounding alarms. They're quietly repositioning, selling at the top, moving into cash, waiting, because they know what's coming. The pattern. Here's the truth. Financial collapses don't happen randomly. They happen cyclically, and the cycle follows a predictable pattern. Phase 1. Easy credit inflates asset prices. Phase 2. Speculation replaces investment. Phase 3. Debt reaches unsustainable levels. Phase 4. A trigger event, a bank failure, a rate hike, a geopolitical shock, shatters confidence. Phase 5. Liquidity evaporates, prices collapse, and wealth transfers, from the unprepared to the prepared. We're somewhere between Phase 3 and Phase 4 right now. The question isn't if it will happen. The question is when, and whether you'll see it before it's too late. The takeaway. So what can we learn from 1929? First, systems built on debt and speculation always collapse. The only variable is timing. Second, the people who understand the system, who see the pattern, who prepare in advance, don't just survive the crash, they profit from it. And third, history doesn't repeat, but it rhymes. The tools have changed. The scale has expanded. But the mechanics are identical. In 1929, most people didn't see the crash coming because they believed the system was too big to fail. They believed the experts. They believed the market would keep rising forever. And when it didn't, they lost everything. Today, the same belief is being sold again. Central banks are in control. Technology is different this time. The Fed won't let it happen. But the Fed didn't stop 1929. And they didn't stop 2008. They just delayed the inevitable and made the eventual collapse more catastrophic. Because in the world of wealth and power, crashes aren't accidents. They're features. They're how wealth is transferred, how empires are restructured, how control is consolidated. The silent replay of 1929 is already underway. The architecture is in place. The debt is unsustainable, and the belief is cracking. The only question is, will you see it in time? If you enjoyed uncovering this hidden chapter of history, don't forget to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just rewrite what you thought you knew about power. The game is always rigged. The question is whether you're playing it or being played by it.